Jeff, what inspired you to launch Bitcoin Denominator Group, and what problem were you trying to solve in the marketplace?
The Bitcoin Denominator Group was really launched because of my personal experience and journey getting into the digital asset space. I can honestly say that Bitcoin has changed my life and my family's life and my friends' lives as well. And I wanted to replicate that to a broader audience to really help them navigate the digital asset landscape and focus on the digital assets that are going to matter in the next age, the digital age. Bitcoin being the predominant one, Bitcoin being sort of the tree of life that bears fruit to other cryptocurrencies. And, some of those cryptocurrencies die and others flourish. So my experience in technology and financial markets is what really led me to Bitcoin, which opened up opportunities to manage capital. And the Bitcoin Denominator Group is a natural extension of that.
How has your investment philosophy evolved since you started the Bitcoin Denominator Group?
Hmm. Well, when I started managing money for other people, I really primarily started managing money for myself and my friends and my family. And I started off as a day trader. And it was very exciting. I had worked with a partner who showed me a particular day trading strategy that worked really well for them. With his blessing, we automated his strategy and started developing day trading algorithms. I've been day trading every day since 2014. And what I learned about the traditional market, um, some of the things that I learned about the mechanics of the market were concerning to me, such as just settlement times, payment for order flow, um, things that really taught me that the market really isn't as efficient as people suppose it is. And from a day trader's perspective, that really was illuminated early on. And during that time, I really had not found an investment that I could just park my money into for the long term and kind of sit on it and let it appreciate. I wasn't invested in real estate other than my own personal home back in 2014. I wasn't really sure I wanted to be fully invested in the S&P 500 either, just because of the way it was backstopped by the Federal Reserve and by money printing and inflation. And so I love day trading because I felt like, I could be in cash at night and, I could just churn that every day. But as I got older and I matured, I realized that, I really needed to find a vehicle that I could park capital into for the long term. And it wasn't until 2017 that I saw the price appreciation of Bitcoin when it went from 1,000 to 20,000. And that caught my attention as a trader. I thought, wow, this thing is, there's something real to Bitcoin for it to continue to exist and to appreciate this much in just a matter of 1 year. So as a trader, I studied it before I started buying it. And I waited until it had come off of its peak in 2017 at 20,000 until it was significantly below 10,000, until I started buying it. And then the more I bought, the more my philosophy changed in regard to what Bitcoin is. And I started to realize that despite the volatility, Bitcoin is something that people can park capital into for long-term capital appreciation. And as a result, it's changed my life, and it continues to be one of the best performing assets in the world. And I believe it will continue to be one of the best performing assets. So my philosophy has really changed from being a short-term day trader to looking at digital assets that I can park capital into for the long term. And part of that goes back to my background in technology and working at Microsoft and building trading software, where in order to understand the protocol or the code, you actually have to look under the hood at the underlying software and what it does. And once I started looking at Bitcoin's protocol and other cryptocurrency protocols such as Ethereum and Zcash, I started to realize that some of these digital assets are going to continue to appreciate, at least in their dollar denominated terms. And they're assets that I could park capital into for the long term. And in fact, my philosophy developed so much between 2018 and 2020 that I had a rare opportunity to put my entire 401k into those three cryptocurrencies in 2020 when most IRAs weren't offering digital asset exposure. And so it was a great opportunity to really take my conviction and park more capital into the protocols that I believe will define the next century. And so my philosophy has kind of changed from a trader's philosophy into an allocator's philosophy and an investor's philosophy, where I still do actively manage our fund and I do look for short-term and medium-term trades, but I'm really more concerned about strategically helping people get into the digital asset economy without getting wrecked, which unfortunately has happened for many people in this space.
Bitcoin Denominator Group, does the name imply what it sounds like, that you measure the fund's performance in terms of Bitcoin rather than in terms of like your local currency, which I think for you would be US dollars?
I love this question. From a practical standpoint, at this point, no, we still measure performance in US dollar denominated terms, but we are going to start using Bitcoin denominated metrics to measure our performance. Really, what the name implies is the evolution that Bitcoin is going through, where early on, Bitcoin was predominantly a store of value and viewed as digital gold. And where today it is actually a medium of exchange that you can use for everyday purchases without the merchant even knowing it. I mean, companies such as a Square and Cash App, there are many more companies that are creating POS systems that allow you to transact in digital currencies and swapping it to USD on the back end without you even knowing it. So the medium of exchange narrative has proven itself out. The next major narrative, obviously, as you mentioned, is the unit of account narrative, where people actually look at Bitcoin as a unit of account, sort of like they did with gold, and other units of account in the past. They could be, oil or other things.
And when you evaluate a investment opportunity in the crypto asset space, what are some characteristics that you look at? Because a lot of these crypto assets, they don't, to my knowledge, don't pay any dividend or any sort of cash flow. So I'm curious how you analyze the space.
Great question. It really comes down to like a game theory perspective and what need does the underlying blockchain technology fill in our current environment. And so I mentioned kind of Bitcoin filled that, store of value need. It has a hard fixed supply. It has absolute finite scarcity with only 21 million. Its protocol is designed so beautifully, from the fee mechanism to the block size to the block time. When you get into all the nuances of it, you really understand like, oh, this is filling that store of value role. Whereas Ethereum really fills, that decentralized application platform role. It's much more flexible. The governance is much more flexible. You can develop decentralized applications on top of it. Institutions are launching stable coins on top of it. So it fills a different role. And Zcash fills the role that sort of cash does in our society, where Zcash is a privacy coin. And, people kind of balk at the word privacy, but In my mind, privacy is not, hiding something. It's actually just concealing information. We sign up for all these services like Facebook, and our data gets harvested and used without our consent. And privacy is basically just giving institutions and corporations consent to use our data. And I think transaction data does matter in that regard too. So when I look at the environment and I look at what is a blockchain protocol that I could park capital in for long-term appreciation, I really look at what is the need it's filling. And I look at, the technical specifications of the blockchain protocol. But more importantly, I think, and this is probably the most important thing, I ask the question, is this an open network or is this a closed network? Is this a closed system or an open system? And a decentralized cryptocurrency that operates on an open network allows anybody to participate in that network. So you don't necessarily need permission to build on that network. You don't need permission to own a token, the native token for that network. You don't need permission to maybe run a validator node or mine the currency in that network. It's sort of like open source code, right? I can go to a GitHub and I can look and I can see the exact code for how this protocol works. Open networks, I think, are going to be adopted globally. Closed networks are more like a security, right? You need to have certain permissions in place. And I'm not saying whether one is good or bad, but for me particularly, I look for open network protocols that I can actually participate in. That way I can use the blockchain technology. I can actually use the cryptocurrency. I can actually contribute to the network. And as somebody who has been in this space for quite a while, I love to experiment on top of these blockchain technologies. I've experimented quite a bit. And in order for me to understand the blockchain technology, I need to be able to interact with it. I need to be able to experiment with it in order to validate that this technology will fill the gap that I'm looking for it to fill. Does that sort of answer the question?
Yeah, absolutely. And how do you separate sort of long-term innovation in the crypto asset space from short-term market noise?
Oh, that's hard. And that's where a lot of people get lost in this space because there's a lot of hype. Right? There's constantly a new shiny object to go chase after. And so part of that is looking at the team, right? Is there a foundation behind this? Is this cryptocurrency? Is there venture capital behind this cryptocurrency? What is all the hype about? So oftentimes when I hear the question like, Jeff, what do you think the next Bitcoin is going to be? I oftentimes think, well, there's not going to be another Bitcoin. Bitcoin is unique and specific in its own regard. Most other cryptocurrencies try to emulate Bitcoin to some degree or create a different kind of protocol with features that Bitcoin just doesn't have. So the question kind of becomes, is this something that is a shiny object that people are temporarily chasing after for short-term gains? Which, again, as a trader, that's fine. If you're trading a hype cycle or a narrative, you can do really well. And that's kind of what I used to do with stocks. But for cryptocurrency and for finding cryptocurrencies that you really want to own for the long term, for long-term capital appreciation, you really got to decide, okay, what specific market need does this cryptocurrency fill so that I can have the confidence to park some capital into it and sustain any volatility for the long term and potentially add more or dollar cost average into it to own it for the long term versus what is that next shiny object? What is the hype around? And a lot of the word crypto, I don't even really like that word crypto because it definitely is associated with, I would say, short-term incentives, which are more profit-driven. We had the Trump coin come out after the election, and I don't know if that was a great thing, right? In many cases, people got burned on that coin because it basically shot up and then went down to zero. And you got to kind of wonder, well, why were people chasing that? Why were people buying Trump coin? Why were people buying Dogecoin? Why were people buying Shiba Inu? Why were people even buying these cryptocurrencies? And if it was just for a short-term gain, then that's fine. That's great. It's just a trade. They were flipping it. They were playing the charts. They were trading. They were maybe using algorithms. Maybe they were searching and scanning for news articles to try and be early and be first in line before the narrative really hit. That's great. Those strategies can really work well. And those are strategies that I've employed in the stock market. But when you're looking at a cryptocurrency that you want to hold for a long period of time, you definitely have to be careful which ones you get into.
What lessons from previous market cycles have influenced how you think about managing risk today in the space?
Man, you've got some great questions, Pete. So this goes to something that is currently happening again today in the industry, which happened in 2022 and really blew up in people's faces. And that's when you search for yield with a product that doesn't generate income or doesn't generate yield. So you can separate Bitcoin and Ethereum here, because Ethereum you can stake. You can actually generate an Ethereum-based yield by staking your Ethereum. So that's fine. But when companies come out and make promises or guarantees that they're going to generate a 12%, a 15%, 17.5%, a 20% yield for you, and that actual underlying cryptocurrency isn't a yield-bearing cryptocurrency, you got to ask, well, where does that yield come from? And in 2022, there were a lot of companies overpromising yield, and it backfired really bad. BlockFi is one of those companies. Three Arrows Capital, Terra Luna, Celsius, Voyager. One of the heartbreaks that I have was back in 2020. I was just begging my good friends and family to get some Bitcoin, get even a little bit. This is when it was below 10K. And that year in 2020, I think it traded as low as like $3,000 or $4,000. And I'd already decided this is where I want to park most of my net worth. And I'm trying to help people get into it. And I remember my best friend, he got into it, and he got into it through Voyager. And I asked him, well, why did you choose Voyager? And his response was, well, they're offering a yield. I can get 15% on the Bitcoin that I hold in Voyager. And I said, buddy, Bitcoin is not a yield generating product. There's still no regulation around this industry. The best thing to do with your Bitcoin is probably put it in self-storage, right? Cold storage. So you control your own private keys. So you manage it yourself. You're not subjugated to counterparty risk when you do that. But he's like, well, I was always taught that compounding interest was the greatest way to build wealth. And I just couldn't, talk him off of being in Voyager. And I remember in 2020, I saw the notification on my phone that Voyager had filed for bankruptcy. And there was nothing, nothing he could do. He was stuck. And my heart broke, because I'm like, well, unfortunately, that's the lesson he had to learn. But for me, I learned from some of the Bitcoin OGs. They're also known as cypherpunks. These are like the crypto anarchists, right? And one of the things that I learned early on about Bitcoin was rule number one: never tell anybody how much Bitcoin you have. Of course, as a fund, that's fine. We will tell people how much Bitcoin we have, as we should. But as a private individual, you don't need to do that. Rule number two, which is very important: not your keys, not your coins. And that's sort of the idea of taking counterparty risk out of the equation. But unfortunately today, a lot of people still have the mindset that it's either too technical or it's too difficult, or perhaps they just want some sort of plausible deniability because they think and believe that FDIC insurance will cover them, which is a whole nother topic, but FDIC insurance isn't even over collateralized. So there's risk there. But anyway, I think that was a major pitfall, is just be careful what you believe in terms of whether or not these products can actually generate a yield for you. I believe eventually they will, to some degree. I believe that idea is being tested right now significantly, especially with Michael Saylor, who owns around 840,000 Bitcoin. Is one of the largest Bitcoin holders in the world through their company, and they've began offering perpetual preferred shares into the public equity market. You've probably heard of these, some of these products like Stretch or Strike or Stride. They have like 4 or 5 of these products, and they offer a yield for holders. Well, last month, Stretch lost its peg. It's supposed to be pegged at $100 per share, kind of like a bond, and it's going to issue 12% annually. But it dropped down to as low as $80 per share last month. And so I think these products will continue to evolve. And I actually really hope that Michael Saylor and strategies succeed. But it's just an example of one of the pitfalls that people get into when they're really concentrated on generating income or generating yield in the cryptocurrency space. Now, I'll caveat that by saying there are tokenized products that you can use to generate yield. BlackRock, I believe, has created a perfect example of this through their Ondo product. ONDU, I believe, is the symbol. But basically, they've tokenized short-term T-bills that generate a yield. So they're tokenizing bonds, which is great for people who seek yield and seek income and want to do that through a traditional vehicle. But really, it's a learning curve in being able to separate and understand what is cryptocurrency. It's very nuanced. It's very expansive. There's not one good definition. In fact, the whole word itself, cryptocurrency, it's kind of a bad word. You got real world assets. You got tokenization. You have layer 1, layer 2. You have oracles. You have all these different things. You have meme coins. I mean, you really got to take the time to do your research and study up on what are the differences between these things. And again, ask that question: Are they operated on an open network or a closed network?
What was Voyager doing? So you would store your Bitcoin with them and earn 15% in interest on it. And were they lending those Bitcoins or crypto assets out to short sellers at a higher interest rate, or how did they make money?
That's a great question. It's a nuanced one, and I'm not qualified to answer it. I don't know the answer, so all I can do is speculate on what they were doing. But certainly, they were either probably lending it out, making riskier bets, maybe shorting, or maybe just overpromising. Right? New customers were actually providing the yield that they promised to old customers, sort of like a Ponzi scheme. I don't know, and I hate to disparage particular companies or even individuals for their actions, because oftentimes the road to hell is paved by good intentions. And so they may have started off really innocent, hoping to help people, and the model just was so bad that either they ignored the blind spot, or they just kept pushing the product that really shouldn't have been created in the first place.
How have institutions changed the crypto asset landscape over the years?
So, yeah, this is a great question. I think they've brought crypto to the mainstream. BlackRock's Bitcoin ETF, which was launched in 2024, was the most successful ETF launch in BlackRock's history. Like significantly bigger than their gold ETF. And I think what that did was open up institutional allocators and fund managers to the idea that cryptocurrency is a real asset, a real investable asset. So it brings, the high net worth individuals, it brings the family offices to the table to ask the question, how do I get exposure and how should I get exposure? So it's done great in terms of adoption for the industry. And Bitcoin is for everybody. And I think that's sort of some of the challenge right now, because the original cypherpunk ethos of, be your own bank and hold your own private keys and all those things that, came about after the 2008 financial crisis, which birthed Bitcoin, because Bitcoin was developed in 2008 and then launched in 2009. All those principles, Bitcoin is at the end of the day for everybody. And so the institutions don't really see things the same way the, Bitcoin cypherpunks and OGs saw things. But it doesn't matter, because Bitcoin is for everybody. So if Bitcoin can't succeed because of institutional adoption, because it's kind of contrary to this, this financial anarchist movement or whatever, then it's just not going to succeed, and it wasn't meant to succeed. As a whole, I think institutional adoption is a net positive. And in fact, it's been around since 2013 with companies like Grayscale. It's just Grayscale had a limited model, because by that time in 2013, the SEC wasn't issuing or they weren't allowing crypto ETFs to be issued, right? So Grayscale had to use this trust model, which actually opened up institutional adoption for Bitcoin and Ethereum back in like 2013, which was amazing. But certainly over the last 2-3 years, institutional adoption has ramped up dramatically. And I think it's going to really help adoption in the long run. So it's a net positive in my mind.
What are some of the most common misconceptions about Bitcoin that you see from potential investors, or just from market participants in general, even if they're outside the crypto asset space?
I think one of the most misconceived ideas is that Bitcoin is volatile. Because people who say Bitcoin is volatile, they're strictly looking at Bitcoin from a US dollar denominated price standpoint. They're not really game theorying out the entire reason why Bitcoin exists in the first place and the actors and participants in Bitcoin. It's real people who are volatile, people who buy and sell, that create that volatility. And so when you have an asset like Bitcoin that has a low float, meaning most Bitcoin holders are also known as hodlers. It's just kind of a funny term in the space, because they deal with the volatility because they understand what they own and they hold through it, such as myself. But because it has such a low tradable float, it's very easy for that price to go up and down, 5% on any given day or more. And so I think what people need to realize is that when you have an asset with a market cap, right now it's about $1.25 trillion. It's a teeny speck in terms of the total addressable market, and it has a really low float. You're going to have people entering in it for what I call NGU, right? Number go up. And so these people are going to create volatility because they don't actually know or realize or understand why they own this thing, or perhaps they're just trading it, which is fine. I've traded Bitcoin before too. But that creates volatility, which is a misconception, because people think Bitcoin is, in that case, a speculative asset, or there's a lot of uncertainty around Bitcoin, when in actuality, Bitcoin is the single best self-regulated protocol that has ever been created. We can anticipate and know to the exact T how many Bitcoin is going to be created because of its protocol, and the fact that every 10 minutes, 3.125 new Bitcoin get mined and created and into the ecosystem. We can calculate with precision exactly when the last Bitcoin will be created. That's not volatility. That's certainty. That gives us an ability to project out into the future and predict what the inflation rate of Bitcoin is going to be. In fact, the dollar, in my opinion, is way more volatile than Bitcoin because of what happened in 2020, for example, when roughly 30 to 40% of all dollars in circulation were created with the snap of a finger during the COVID pandemic, which eventually led to the debasement of the dollar even further, where like a dollar is worth like 95% less than when it was created in 1913. I just I just find it kind of fascinating that people view volatility as a negative thing, and when they're only looking at it from like a U.S. dollar denominated price standpoint, and they're not looking underneath the hood and looking at how beautifully designed this protocol was created. It's self-regulating protocol. Even the fee mechanism of Bitcoin is a self-regulating mechanism. Even the block size limit is a self-regulating mechanism. Even the Bitcoin time to create a block is a self-regulating mechanism. And I know there's a lot of nuance there, and I don't want to get too much into the technical weeds, but all these things that allow the protocol to exist and function and flourish and run self-regulate it so that you can have certainty in other things other than the US dollar denominated price. So the question really at the end of the day is how much volatility, so separate the uncertainty from the volatility, separate the speculation from the volatility, and how much of this asset can you comfortably own given the fact that its US dollar denominated price is volatile? So what we recommend generally is like, anywhere between 2 and 10%. It's really circumstantial. It's really based on what the investor or the client, feels comfortable with, that they can sleep well at night, knowing that they're not just going to wake up one day and 25% of their net US dollar denominated net worth is, in the toilet.
In oil and gas, when you pull oil out of the ground at the extraction point, you have to bring it to a collection point, and there's a price differential there because there's transportation costs. I'm curious, in Bitcoin mining, is there a differential between the price of mining new Bitcoin on the primary market and then where they trade on the secondary market?
This is, oh man, Pete, another great question. In my mind, the answer to that question is really difficult to determine, but there are metrics and ways that people are trying to calculate that. So one of the metrics that I follow is the cost of production. How much does it cost to produce one Bitcoin unit? Last I checked, it was around $58,000. And if you look at a historical price chart of Bitcoin, it's US denominated dollar in US dollar terms, it's rarely, if ever, gone below the cost of production for very long. And included in that cost of production is the electricity cost, right? How much does it cost to actually set up a large mining facility somewhere in the world that allows you to economically benefit from the activity, the mining activity? And I think it's very jurisdictional, right? Because there are places with cheaper sources of energy. I think it's very political because there are regulations that determine how you can use that energy. So at the end of the day, the Bitcoin miners that will succeed and win and live a long time, if they're just strictly mining Bitcoin and not doing other things like AI related activity, will find the cheapest sources of energy. So, that can be thermal, that could be solar, that could be hopefully renewable energy that becomes cheaper over time. But I think the answer to your question stands like politics and jurisdictional differences stand in the way of, Bitcoin miners really being able to capture that energy in a way to maintain their operations, because the cost of capital is high. You have labor, you have equipment, you have to replace the equipment. But yeah, I look at 58K Bitcoin, the cost of production, and say, okay, that's sort of a good area to really, test whether or not, Bitcoin is really backed by energy. And I think it is. Bitcoin is a form of money that is backed by real energy, which is a beautiful thing I think we need to get back to.
Another question along that line, uh, power producers, let's say it's a gas to power play, they will lock in their gross margin by selling electricity. So they'll be short electricity futures and they'll be long futures in natural gas. So they lock in their spread. Do Bitcoin miners do anything like that, where they're long electricity futures and short Bitcoin futures to sort of lock in their gross margin?
Yeah, there's a company called Luxor Mining that I think does that exact same thing. Indeed. I don't know too much about it. I'm not in that business, but yeah, they do that.
What trends in the space are you excited about over the next decade?
Mm. You know, one of my favorite uh, trends, which I don't want to call it a trend because it kind of implies that it will come and go, but one of the hot topic ideas right now is tokenization. And I think tokenization is coming quick and coming fast. And it is also a little bit scary. It takes me back to that 2021, 2022, 2023 bear market that we were in. 2021 wasn't a bear market, but it was the start to it. When we had all these ideas of financializing cryptocurrency and financializing Bitcoin that blew up in our face. I hope the industry learns from past mistakes, because tokenization could create some risks and things that we're not quite ready for. But tokenization is coming. Tokenization is the idea of having an asset, having a real world asset, and wrapping it in a digital wrapper, a digital token. But there's a really important distinction here to make, where Bitcoin is a crypto token, right? Or a crypto coin, for lack of a better word. It's just nomenclature. It's really not a coin at all. But the difference is Bitcoin, Ethereum, Zcash, Solana. These are all tokens that are native on the Bitcoin blockchain. These tokens, these coins, they live on the blockchain. They were bred on the blockchain. They transact on the blockchain. And now with tokenization, we're looking to take real world assets and wrap a digital wrapper around them. Tokenized gold, tokenized real estate, tokenized treasury bonds. Whereas the concern that I have around tokenization goes back to what I learned when I was day trading, which is part of the disadvantage in public markets is that there's not an immediate settlement time. Markets close at night. They're closed on the weekend. They're closed during holidays. There's also a lot of trust me, bro, semantics around, the whole public market, private equity, private credit space. Whereas with an on-chain digital asset, you can verify, you can attest, you can validate that asset is where it's supposed to be. Whoever owns it or says they own it actually owns it. And you can validate and verify the price of it because there's a market for it at any time, 24/7. What concerns me a little bit around tokenization is that I don't think you have that same level of transparency as you do with a tokenized real world asset that you have with a tokenized native asset. Or I shouldn't even say tokenized native asset. It's a native blockchain asset. You don't have that same level of transparency. So the problem that I'm trying to solve and work on right now is, how do you attest and validate and verify that the tokenized real world asset has the liquidity, has the value, who owns it, how does it get settled? Those things, those are the properties that I'm particularly interested around this whole concept of tokenization that I'm looking for when a company or a firm comes out with a tokenized product of any sort, because transparency is very important, more important, I think, now than at any time in history. And we really need to build trust around this industry. And, unfortunately, we don't have a good track record of doing that because of all the scams and misappropriated funds and etc. So I think we need to keep our eye on the ball here when it comes to tokenization and ask the question, okay, if you're going to tokenize real estate, how do you test the valuation of that real estate? Are you locking up that real estate into like a 4-year contract? That's fine. Just be transparent about it. Just be very transparent about the redemption mechanics around that tokenized asset. We had a Blue Owl Capital in February. I believe a private equity firm, actually public. No, they're a public company. Excuse me, I'm trying to recall the history, but they caught my attention last February because they're a $300 billion equity firm that halted redemptions for their LPs after the lockup. Their LPs expected to get a capital distribution, and they were locked out of their capital. And then it like trickled down to Morgan Stanley and BlackRock, and there was this big problem. It's like, how do you ensure the liquidity, the settlement, the redemption mechanics for a tokenized asset? And that's a problem that I'm working on right now.
Are these tokens just a way to move the underlying asset or claim on that asset around more efficiently with lower transaction costs? Or are they also a form of debt against the asset? So can I buy a token that has a return, some rate of interest based on an underlying pool of assets?
I think it's a combination of both. I think there are a lot of different ideas right now swirling around how to tokenize and what to tokenize. So I think both of those are options. But again, I think it really goes back to transparency. What are the redemption mechanics around the token? What are the ownership mechanics around the token? Is this an investment token that is more similar to a security? So there's a higher regulatory threshold that perhaps only accredited investors can own this token? Or is this more of a utility token that provides some sort of capability or utility, like a payment network or a stable coin or something like that, that doesn't have so high of a regulatory threshold? Either way, at the end of the day, I think the key is transparency, auditability, right? How do you audit that these tokens actually own the underlying asset? I think it's going to be an interesting transition. I don't think it's going to happen overnight. And I think the companies rushing to prove a model first are the ones that should be scrutinized the most. Because the question is, are they chasing a shiny object, or do they, because we all see this coming. We all see tokenization coming down the pipe first. And there are going to be a lot of people who want to capitalize on this idea, but are they doing it in the right way? Are they doing that in a way that the people who are buying this token really understand the economic benefits and the governance rights associated with that token? And so again, we have to think critically about this idea of tokenization and what problem is it really solving. And I don't know if there are good uses to tokenize everything. It really comes down to the model. It comes down to what blockchain you're using. It comes down to how the smart contract is written. Those things matter, much more than like a marketing ploy for tokenization.
At Bitcoin Denominator Group, how do you guys differentiate yourselves on the investment research side from other firms?
We are in this every single day, every day. We know what's coming. We know what blockchains look to provide value to the ecosystem, and we interact with these blockchains too. I think one of the ways that we differentiate is by having an open-ended hedge fund structure. So we have monthly liquidity. Another way that we differentiate is by offering in-kind contributions and in-kind contributions. So if people want to come into our fund with their cryptocurrency, they can. We also offer, we're going to offer proof of reserve. So we're working on a system where our investors can actually verify and validate that we have the Bitcoin that we say we have. We're working with Kraken Finance right now, which is the first crypto bank to receive a Fed master account. So we're doing everything right by providing optionality and providing mobility, and understanding the significant questions that investors have in this space right now. One of which I don't think a lot of people understand is coming down the pipe is a hard fork. In August, there's a hard fork coming for Bitcoin. And a hard fork is basically there's a group of people that want to change the underlying protocol. They were unsuccessful in doing that because the balance of powers in and around Bitcoin governance prevented them from changing the protocol, which is a good thing. So they decided that they are going to take the code base, the Bitcoin code base, make some minor adjustments, which is going to cause a chain split and essentially a new forked coin. So everybody who owns Bitcoin, if you own it in a self-custodial wallet, at least, not all exchanges are going to adopt this, are going to essentially get free money because this other coin is going to be created and then there's going to be a market for it. Whether or not it succeeds or fails is TBD. But this is something that I have my head wrapped around right now. I'm asking Kraken, I'm like, hey, are you guys supporting this coin? Because if not, we're going to want it. We want free money too. And we're going to put it into a wallet that will allow us to have this fork coin so that we can choose what we want to do with it for our investors. I don't hear a lot of crypto hedge fund managers talking about this right now. So one of the advantages, like, we are in this space. I live on a Bitcoin standard. Most all of my wealth is in those three cryptocurrency assets that I just mentioned to you right now: Bitcoin, Zcash, and Ethereum. I am incentivized to do what's best, not only for my investors, but for myself and my family because of where I've decided to park my own personal wealth. I'm not just in this for a trade. I'm really in it for the fact that I believe that money is changing. Money is changing in front of our eyes as it always has through history. And it's kind of hard for people to see that. But for whatever reason, I think I see that, which is why I've decided to put a predominant amount of my wealth into this thing. Is it a risk? Maybe. But I would say that most of my life has been defined by unconventional decisions with calculated risks, which has led to open opportunities and open doors and growth. And so I'm a constant learner in this space. I'm constantly experimenting with technologies on the blockchain. And I don't know if all fund managers have that same kind of history that we do.
That leads me to another question I had. In the 1830s through maybe the 50s or 60s, we had something in the U.S. called free banking, where the banks were allowed to issue their own currencies backed by gold and so forth. I think for crypto assets to realize their full value, it has to be somehow integrated with the current system, in my view. Do you think there's a way that free banking could be integrated with the crypto assets, so that people can deposit gold at banks and then the bank issues a token of some sort and they can redeem that token, and you could have banks clearing each other's tokens? Just want to get your thoughts on that. Like, do you agree? Do you disagree? Do you have a different view on how the crypto assets will integrate with the current system?
Yeah, I think they are currently integrating with the current system. And I think they've been integrating with the current system to some degree since 2013, although it started off very minimally, and then elevated in 2017. So in 2017, It was a tremendous bull run when Bitcoin went from 1,000 to 20,000. And under the last Trump administration, at the peak of the bull run, when Bitcoin was at $20,000, the government blessed the CME and the CBOE with the ability to issue futures contracts on Bitcoin. So clearly right there's an example of digital assets integrating with the current system. But what that did, again, was it took real demand for Bitcoin and moved it into a derivative. But again, there was integration there, which is fine. It's great. And then I think there are so many examples ever since that time of how it is currently integrating with the current system. I mean, take the Square app, for example. Jack Dorsey's company, Square, has a POS merchant system that allows sellers, businesses to accept Bitcoin, right, for their goods and services. Or on the other end, if I'm paying for a good and service, I could pay for it with Bitcoin or Ethereum or another cryptocurrency. And the person that's receiving that payment, they swap to USD immediately. So they don't even know that I'm paying them in a cryptocurrency, and the system itself is swapping and integrating the digital asset into the US dollar system. I mean, look at the Stablecoin Act, right? The Clarity Act, the Genius Act. Look at the Strategic Bitcoin Reserve. There are so many things happening in the cryptocurrency space that show that integration is happening, and it's happening quick. The banks are going to be allowed to start custodying Bitcoin and cryptocurrencies as well. Every single day, Pete, I feel like I'm waking up and I'm seeing proof of this integration happening. The problem is most people are so busy and concerned with other things that they don't see it happening like we do, because we are in this space every day. So they ask that question that you just asked, which is a perfectly fine question. And my response is kind of like, I almost want to say something without being too much of a jerk. Like, dude, where have you been? Get your head out of the sand. It's happening right now. But, you got to just deal with people coming from where they're at. And a lot of people don't see the integration happening because perhaps they've never integrated. They don't even know that they're integrating with digital assets, and they are. And stablecoin adoption is a perfect example of this. Stablecoin adoption is gonna be, going back to your question about banks and like the freedom of banking. I really believe that we are going to see new forms of banks, whether or not they're called banks or called something else. They're going to be stablecoin settlement tokens that are pegged to the dollar, models that have these tokens that are pegged to the dollar, platforms that have stable coins that allow US dollar liquidity to perpetuate around the globe. This is how US dollar hegemony exists. One of the blessings that I've had in my life at a young age was I traveled around the world 3 times while working on a cruise line in between 2009 and 2011. And it gave me the opportunity to go to countries where their currencies were failing, such as Turkey, Argentina, Egypt, places in Southeast Asia, places in, Europe, where their currencies had failed or consolidated. And so I think stable coins are going to usher in this next layer of consolidation where sovereign nation states, fiat currencies fail. And ultimately, they're seeking after the dollar anyway. So they're going to be onboarded through these neo banks into dollar peg stable coins or dollar peg settlement tokens. And so the banks, the whole fight from JP Morgan and Jamie Dimon with regard to the Clarity Act and the Genius Act has been against stablecoins because they're seeing this technology whittle away their moat that they've owned and controlled for many years, decades, right? And this technology that we have now at our fingertips aligns perfectly with this book called The Sovereign Individual, which basically it's a book about Bitcoin that doesn't mention Bitcoin once, or you can say it's a book about cryptocurrency, but really it talks about how microprocessing, The phones that we have in our pocket are allowing us to do things that we once relied on the state for, such as banking. So I think we're entering this age and this time of mass confusion where people really aren't sure what's happening. But when you look under the hood at what the Clarity Act is, what the Genius Act is, what tokenization does, what are stable coins, you kind of it starts to make sense. And you can tie together themes from the past and books like The Sovereign Individual and say, wow, this is actually happening quickly. It's here now. And there will be neobanks, whether or not they're called banks, I don't know. But there are some interesting things happening in the space that are allowing people access to dollars through, stable coins.